I think we're in crypto winter. I do. And I know people don't want me to say it, but I think we're in crypto winter. But I don't think it's going to be severe. I just think it's going to be a more mild winter. If your average is 100, what you have is a savings asset. You don't have a speculative asset, I will argue right now. The chances of making a quick buck on 100,000 from here, I think are pretty low. I think the likelihood that we get to, 500,000 in the next cycle, I think is really high. But that's 4+ years away.
Every cycle in crypto feels different while you're living through it, but the emotions are always the same. There's excitement when price runs ahead of itself, confusion when momentum starts to fade, and hesitation when long-term holders begin to ask whether the data still supports their conviction. And that's exactly where many investors find themselves today. But instead of reacting to price alone, this video turns to someone who has studied Bitcoin cycles for over a decade. Mark Yusko, the founder of Morgan Creek Digital, and one of the earliest institutional voices to take Bitcoin seriously. In his latest interview, Yusko makes a clear, measured case that we are entering a crypto winter, but a very different kind of winter than the brutal ones of the past. He argues that Bitcoin's fair value, adoption curve, leverage dynamics, and the shifting behavior of long-term holders all point toward a milder, more structural correction, not a collapse. And when he breaks down why the 4-year cycle still matters, despite ETFs, institutional flows, and the rise of massive new buyers, his explanation reframes the entire debate around where we actually stand today. So in this video, we're going to unpack Yusko's most important insights. Not the headlines, not the fear, the actual mechanics of how Bitcoin's market works, and why this moment may be setting up the strongest long-term opportunity of the next cycle. If you enjoy content that cuts through the noise and focuses on real analysis, make sure to like the video, subscribe, and turn on post notifications for more insightful analysis. Thanks for the support, and enjoy the video.
The nice thing about Bitcoin is it's a network, right? It's physically, literally and physically a network. It's a network of nodes that secure a blockchain that enables Bitcoin to be a better form of money going forward. And therefore we can measure all the elements of a network just like any network. And I have a buddy in the industry, Tim Peterson, who runs a firm called N Squared Crypto, and he's N Squared Value on Twitter. And he's been tracking this model, this Metcalfe's Law model, for years. And based on that calculation, he comes up with a fair value of the Bitcoin network, the Bitcoin blockchain network, at around $91,000 or $92,000 today. And what's interesting is if you look at history, in 2017, that value was 10,000. Now, if you remember, we went from 10,000 in November to 20,000 in December. So we got 2 times fair value. And then we had a big correction and we fell well below fair value until the next bull market started. Then in 2021, fair value had gone up to about 33K, but we went all the way up to 69K in November of 21. And then we had a big correction. So here we are in 2025, same 4-year cycle, fair value at 91. We only got up to 125, 126. We didn't get a full 100% higher. We never hit that 170, 180 that people were calling for. And so I will argue that the correction will be more muted because of that. Because, it's likely we fall not just back to fair value, but probably below. Well, why should we fall below? Well, corrections occur when people who bought for, we'll say, less than ideal reasons. Like if you think about the cycle of any investment, when the price is below the fair value, right? And if that's a stock, it's the discounted stream of future cash flows. If that were a bond, it would be the certainty you have with the payment of interest. Whatever it is, if the price is equal to fair value, you're probably agnostic as to whether to buy it or not. If the price is below fair value, investors will buy to try to close that gap. Well, as the price starts to move, okay, traders are drawn to it because traders don't really care about fair value. They just want movement. They want to go long or they want to go short, and they trade. Well, as the price starts to get above fair value, hedgers emerge. Well, what's a hedger? A hedger is someone who owns a commodity, whether it be oil or gold or Bitcoin. Bitcoin's classified as a commodity, that produce it. And they now say, well, wait a minute, if the fair value is here and I can sell it at a price above fair value, well, I know I'm going to produce it tomorrow, so I'll just sell it in the futures market. And if you can sell an asset in the futures market, you need someone to take the opposite side. Those are called speculators. So speculators are taking the opposite side of a hedger. Well, then that increases the price. Now, when the price starts to really get higher above fair value, now the gamblers come in. And the gamblers not only buy the asset because it's moving, but they use leverage. And leverage is not evil in and of itself, but it's the amount of leverage relative to the volatility of an asset. So what happens is as those gamblers push the price to too high a level, it snaps, they get liquidated, the price starts to fall. And as the price starts to head towards fair value, the traders get nervous, so they sell, and the price gets down. The hedgers can't sell because now the price is below fair value, so they'll just hold it until the price goes back up. And then the long-term investors wait until the price gets down here and they start buying again. So you get this natural cycle. I have empathy for the logic of the 4-year cycle being less relevant because we had a step function change in demand. Because at the end of the day, price is determined by buyers and sellers. And if there's, a lack of buyers, then the price needs to come down to meet that demand. If there's a surfeit of buyers, then the price needs to rise to meet the increased demand. So there is some logic to say, well, we have all this new money going into Bitcoin through the ETFs and institutional adoption, but there's one flaw-ish in that logic, which is, remember, every transaction, there's a buyer and a seller. For there to be excess demand, you would have to have, fewer sellers for price to rise. Meaning, the hedgers aren't producing as much. That's what the halving does, right? The halving intentionally deflates the number of block rewards. And so if I'm a hedger and I own a mining rig and now I only get 2 block rewards instead of 4, my costs are the same. I need the price to rise, so I'm less likely to sell until the price rises, which is part of the genius of the halving in my mind. The difference now is that for every new incremental buyer that we've seen, there's OGs, right? Wallets that have been inactive suddenly selling. And we're like, oh, that's so terrible. No, it's not. Look, if we meaning the community, want there to be billions and billions of Bitcoin owners and users, it can't all be in the hands of a small number of whales, right? Just mathematically. No, you say, oh, but it could, and the new people just get smaller and smaller increments. Sure. I mean, we can divide into 100 million Satoshis per Bitcoin. That's fine. But there are people who have very, very low cost basis who at some price will say, you know what? Yeah, I'll distribute a little bit.
Yusko's network-first argument reframes price action as a function of fundamentals measured across the Bitcoin protocol: nodes, transaction activity, realizations of fair value, rather than pure narrative hype. When he references model-derived fair value approximately $90,000, He's not predicting a ceiling so much as explaining why the market's limited upside. This cycle reduces the probability of a violent crash. Historically, traders, hedgers, and leveraged gamblers create the extremes. Hedgers sell into strength, speculators absorb that supply, and gamblers add leverage until forced liquidations reverse everything. Less leverage now and a lower peak means fewer forced liquidations, and therefore, a more muted correction profile. For investors, that translates into a higher probability that drawdowns are buying opportunities for long-term accumulation rather than catastrophic exits. Contrast that with the bullish camp that points to unlevered ETF flows and institutional involvement as a permanent lift to price discovery. The key differentiator is distribution. Are ETFs and banks truly removing available supply from the market, or are dormant OG wallets and miners still able to satisfy demand at key levels? Yusko thinks the latter can temper exuberance. Practically, watch miner outflows, ETF net inflows, funding rates, futures open interest, and active address growth. These are the metrics that convert the narrative into on-chain reality. And that leads directly into the next layer of his thesis: structural differences between Bitcoin and traditional commodities, especially how leverage and futures dynamics have changed the volatility profile when compared to gold, and why he believes we are now in a bear market. Let's get back to the video.
It's highly likely, Giovanni, that we don't have the same extremes, either up or down, partly because the amount of leverage that people can use has diminished, right? You can't get 100 to 1 anymore. You can get 50 to 1 in some places, and usually it's more like, 4 or 5 times. So if the leverage is less, you won't have the extremes. The reason gold doesn't have as much volatility is it's harder to lever. It's a more mature market. It's much larger, right? It's 10 times bigger than the market of Bitcoin. I mean, gold lost a whole Bitcoin in 2 days the other day, right? I mean, it lost 2.8 trillion in 2 days after going up 10 trillion a year to date. And so the law of large numbers says that you're not going to have the same level of volatility because you can't get the same amount of leverage. There's just not as many people that. The second thing is gold has been a commodity longer than Bitcoin. And what I mean by that is there's a reason Bitcoin was labeled a commodity, not a security. And it's not a good reason, actually. It's intentional. Anything that's a commodity can be manipulated by the largest players in that commodity through the futures market. Well, that's a process known as spoofing, where the big guys, JP Morgan and Goldman and all these other guys in Europe, they are selling futures to compress the price, and they are day trading around it, which is technically illegal, and they pay fines. This is the crazy part. 2 years ago, JP Morgan paid a $940 million fine, almost $1 billion fine, didn't have to admit any wrongdoing. Commodities and futures markets tend to have this rapid movement. That's a short squeeze. Because when the price is being manipulated, you got all these shorts, they're naked, and somebody starts to buy, whoever that is. This time it was China. China started buying gold. Well, now gold went into a super short covering. So all these guys, JP Morgan, they're having to cover their shorts, and we went from 3,400 to 4,400 instantaneously. Okay, well, now what's happening? Now they're back to shorting again. So now they're not shorting at 3,400, they're shorting at 4,400. And we went from 4,400 all the way back down to 4,000. And so it's that constant process of, spoofing, punctuated by these big short covering rallies. And again, this is that distribution. You got the OGs selling into it for the first time, which is good. We want that. We got fewer new buyers. We still have some, but we have fewer new buyers. And we've got the constant downward pressure from the futures market that's kind of capping prices. So, I think we're going to be stuck in a kind of squishy zone for a while. I don't think we're going to have a massive correction like the last 2 cycles because we never got super overvalued. Do I think it could go down into the 70s? Yeah. I think we're in crypto winter. I do. And I know people don't want me to say it, but I think we're in crypto winter. But I don't think it's going to be severe. I just think it's going to be a more mild winter. If your average is 100, okay, what you have is a savings asset. You don't have a speculative asset, I will argue right now. The chances of making a quick buck on 100,000 from here, I think are pretty low. I think the likelihood that we get to, 500,000 in the next cycle, I think is really high. But that's 4+ years away. So what I think people should do, so I was on TV in 2018. And while I was on the show, literally, and I was on the show for like 6 minutes, but while I was on the show, the price went from 10,000 to 8,000. So it was a big move, right? And the host says, well, what should we do? I'm like, we should buy it. She says, well, you would always say that. And I'm like, yeah, I would. Buy it today, buy it tomorrow, buy it next week, buy it next month. Don't buy it all at once. Figure out how much of your portfolio you want to own. Buy some today, buy some next week, some next month, the month after, and keep accumulating your savings bucket, right? Don't put the money that you need to pay the bills into a volatile asset. Stocks, bonds, anything. I mean, that you need that to be in money that you can spend. But if you want to save your value and protect it from the ravages of inflation, you should be shifting as much of your savings bucket out of fiat into Bitcoin. But you shouldn't do it all at once. So in 2021, when we talked, we were in phase 2 of the 4 phases of innovation. So in the first phase of innovation, the incumbents ignore you. So from kind of 2009 to 2015, they ignored it, right? Bunch of nerds and geeks playing with their magic internet money, whatever. Then phase 2, kind of from 2016 to 21, you have the then they laugh at you phase. And they mock you. And stupid idiots playing with your magic internet money. But starting in 22, and I'll argue from 22 to kind of 27-ish, is the then they fight you phase. That's where the incumbents fight back, right? They try to erect barriers. They try to change regulatory rules. They try to, you had the whole, Operation Choke Point. I mean, you had all that stuff. And people say, well, that's over. I'm like, it's not over. I mean, Trump was going to give us a strategic Bitcoin reserve, right? Nope, we haven't seen that. Why? Well, because there's still people in D.C., Elizabeth Warren and others, that don't want that to happen.
Yusko's biggest and most practical takeaway is simple. Treat Bitcoin like a savings asset and plan around that reality. And if you take that seriously, it leads to 4 clear principles for anyone who's investing with intent. First, time frame and allocation. If your goal is long-term protection against inflation and currency debasement, Bitcoin isn't something you trade, it's something you accumulate. That means dollar-cost averaging into a savings allocation instead of chasing short-term volatility. Yusko's message is basically, buy some now, buy some next week, and keep building over time. It's classic risk management for an asset that still moves sharply day to day, but whose long-term math is hard to ignore. In practical terms, decide what slice of your net worth you can treat as savings, money you don't need for bills, and drip that in slowly over months and quarters. Second, use the right risk tools. This cycle is shaping up to be less leveraged and more squishy than previous ones, which means volatility stays, but the extremes may be softer. That's why it's worth watching miner selling, ETF inflows, futures open interest, funding rates, and realized volatility. When miner outflows rise while ETF demand fades, the market can stay under pressure. But consistent ETF buying combined with reduced miner selling is the kind of structural tailwind that catches bears off guard. These aren't signals to pick the exact bottom. They're signals to size your additions with more confidence when the data lines up. Third, the regulatory and market structure phase. We're still in what Yusko calls the then they fight you stage. That means regulatory pushback, messy market mechanics, and narrative battles from incumbents. Yes, this can create sudden sell-offs, spoofing games, and targeted short pressure. But ironically, this is also the process of institutionalization. More regulation, more liquidity, more instruments, more participation from pensions and endowments. The short term looks noisy and manipulated. The long term becomes more stable. For investors, that simply argues for patience. Adoption isn't linear, but adoption is happening. Fourth, the macro bull case is very much alive. Yusko still believes new all-time highs are likely over the next multi-year cycle. 500,000 plus isn't a fantasy in his view. It's just not happening next quarter. And that's the mindset long-term holders need. Short-term winters don't invalidate long-term trends. If anything, these mild pullbacks flush out weak hands, improve distribution, and build the foundation for the next big move. My take: Yusko's outlook is a grounded, sober form of bullishness. He's not sugarcoating the near-term slowdown, but he's also not wavering on the long-term thesis. For serious investors, the playbook is straightforward. Treat Bitcoin as a savings vehicle, dollar cost average consistently, use on-chain and flow data to scale your buys, and stay away from high-leverage and fast-flip trades. Expect corrections, including dips into the low $70,000. But view those as chances to build your position, not reasons to abandon it. If you agree, disagree, or track your own favorite metrics, drop them in the comments. I'd love to see your fair value target and why. And if this helped refine your strategy, hit the like button, subscribe for more deep dives, and ring the bell so you don't miss the next breakdown of market-moving interviews. Thanks for watching, and see you in the next one.